Good afternoon to those of you in the United States. Good afternoon, Mr. Kaplan, Rob Kaplan, who's the President and Chief Executive of the Federal Reserve Bank of Dallas in Texas, very much in the eye of the storm right now. My name is David Marsh. I'm the Chairman of OMFIF. I'm very pleased to welcome everybody. We'll be looking for questions from the audience in the second half of this 1-hour broadcast. We're going to be ranging over quite a wide range of different questions, ranging to start off with from what's happening on the ground in Texas and in the United States with the COVID-19 crisis. But we want to get into a few more long-term issues, both domestic and international. And Mr. Kaplan is very kindly willing to give us an hour of his time. And I'd like to say all of this is totally on the record, and it will be streamed also live by our friends from Bloomberg. So Mr. Kaplan, you're here to make some public statements and things which take us a little bit further forward. If I could just start off though with the situation on the ground. Now, you've been at the Dallas Fed for 5 years, nearly 5 years now. Before that, you had this impressive period at the Harvard Business School. You missed the crisis, you might say, because you were, during the last crisis, you were at the Harvard Business School in charge of management practice and also one of the associate deans there. Before that, you had 23 years at Goldman Sachs and you had your fair share of ups and downs. Looking at the situation in Texas now, from the light of all this experience, where are we now? We did have a bit of a premature lifting of the restrictions in May and June. That's now been thrown into reverse. What is it like now on the ground in Texas?
Well, so there's a number of questions in that. Let me just mention to put it in context. This crisis, this downturn is different than every other downturn I've experienced or has happened in recent history, because at least in the financial crisis, as bad as it was, for most of, we had 90% of the population was working. In this crisis, we went through a period at the start where a substantial percentage of the population was either not working or were home and not productive. And we really haven't been through something like that for an extended period of time. So what the imprint of that was is we had a substantial decline in the second quarter in GDP, centered primarily in part of March and in April. We started to recover, and this is true of Texas, but it's true of the country. We started to recover in May. We started to recover in June. And then with the resurgence of the virus in the latter part of June, that recovery began to slow. And we saw that in the high frequency data in this district, but we saw it in the high frequency data nationwide. And so it is still our view at the Dallas Fed that we'll grow at a healthy rates in the third quarter and in the fourth quarter. And it's still our view that even in the third quarter, we could grow at an annualized GDP rate of 20%. But as impressive as that sounds, it's coming off a 35% annualized decline in the second quarter. So you'd expect a rapid rebound. The comment though I'd make is, and I see this in Texas and I see it in the country, the rebound won't be as pronounced as it would have been because of the resurgence of the virus and our performance in managing the virus. But by the time we get to the end of the year, it's my view that we'll have a 4.5% to 5% contraction and unemployment rate of 9 to 10%. And as it relates to Texas, we've seen since June a spike in cases, a spike in hospitalizations. In the last several days, we're starting to see some of those statistics moderate, and hospitalizations have begun to moderate, but we're still at elevated levels of the virus. And so we're just not rebounding as fast as we would have.
Is that tailing off? Is that partly because people have been following the sensible advice now from the governor and yourself? You've been making a big point about wearing masks. Is that the reason why things are starting to look slightly better from a pretty terrifying situation that we had at some stage during July?
Part of what happened here is some of the reopening protocols got phased back. So density in restaurants got phased down to lower acceptable percentage of occupancy. Bars were closed. And yes, I think people are now in a more widespread way wearing masks, and more businesses are making it a requirement that if you're going to come into their establishment, you have to wear a mask. And lastly, people are just being more careful because of the resurgence. So I think that's all contributed to this being muted. The thing I keep saying, and I'll say right now, epidemiologists, infectious disease experts have convinced me at least, and have been very strong and consistent in saying, if we all wore masks, we would substantially mute the transmission of the virus, and within 4 to 8 weeks, we would be able to knock down the transmission rate of the virus to much lower levels. So we can manage this. We don't need to lock down to manage this, although in certain isolated cases that may have to be reviewed. We can manage this through following these healthcare protocols. And if we got the number of cases down, then testing and contact tracing would become far more viable and effective.
As you say, you're not an epidemiologist. You're in charge of money these days. You've got your finger on the interest rate trigger. Does this not show somehow the limits of monetary policy, that here you are, you're calling upon people to wear masks? You're not saying we can solve this by waving some magical monetary wand.
That's correct. Monetary policy has, on the one hand, a key role to play, and fiscal policy has a key role to play, but they're only a bridge to us following the healthcare protocols and managing the virus. If we don't manage the virus effectively, the bridge that monetary and fiscal policy create will not be as effective as they would have been, because the bridge is to lower transmission rates, more engagement of consumers and individuals in the economy. But that's the key. That's center stage right now, is managing of the healthcare protocols.
Does that keep you awake at night? Because after all, we collectively around the world, not just in the United States, have really thrown the kitchen sink at this disease with unprecedented fiscal and monetary measures. Let's say that's not enough. Let's say the virus comes back in some way and we need to do all this all over again from the fall onwards. How can we possibly do that? Isn't that a nightmare situation that could be staring us in the face?
It does worry me. It worries me about if we don't do a good job managing the virus, it means more government debt, more need for fiscal stimulus, more need for monetary action, bigger Fed balance sheet, and it means we'll grow more slowly and we're going to have a higher unemployment rate. And that does worry me. What encourages me is the virus, when it first started, happened to us. In my opinion, where we are now, we have the ability to manage this. Not perfectly, but we've got the ability, if we can follow the healthcare protocols and all work together and be disciplined, we've got the ability to manage this and improve the performance of our economy and limit the need for substantially more fiscal and monetary policy. But we can only do that through much better performance in managing the virus.
Everybody's learned a lot from this disease. I myself, of course, didn't take this mask wearing terribly seriously. I do now. You do as well. You've learned from that. You've been somewhat critical of what you call lack of leadership in some parts of the United States. Is this not somewhat unusual for a member of the FOMC to get into the political field, as you have been doing, by implicitly criticizing the political leadership?
I'm not. I haven't actually been critical of leadership. What I've said is, the adherence to the healthcare protocols has been uneven. Mask wearing, there's been some confusion about the effectiveness of mask wearing. There's been some, I think we might have benefited from some national initiative on testing in particular and the availability of testing. But I think ultimately this is a leadership opportunity for all of us. But I think ultimately how we do in this virus is going to depend on all of us, citizens, doing our part, and leaders calling on us to do our part. So no, I'm not criticizing leadership. I am saying we can do a better job than what we've done. I'd say our adherence to these protocols has been uneven. and we can do better.
Because I want to get back into some of these more systemic issues a little bit later on. We do have an election coming up after all in the United States, and that will be playing a role there. But just sticking to monetary policy just for the moment, let's say we did get into a worsening of the situation. Some of your relatively optimistic ideas about some buoyancy in the third quarter, let's say that came to nothing. What has the Fed got up its sleeve? You've already done a great deal. There was a lot of talk before this crisis about the Fed and other central banks, quotes, running out of ammunition, end quotes. Clearly, that didn't happen. What else could you have up your sleeve? And could that include negative interest rates?
I don't believe it's going to include, I do not believe it will include negative interest rates, no. We've already said publicly that we're going to keep rates low, at least for the next couple of years. We did that through our summary of economic projections, the dot plot, the SCP. We are we've just extended the sunset date for many of these 13.3 programs till December 31st. And these are programs that provide backstops for corporate bonds, municipal bonds, and have helped stabilize the financial markets. And they've been effective, so effective that we haven't had to use much money actually. The markets have money has flowed into these markets. One area where financial conditions are not loose and we are seeing stress is in small, mid-sized businesses, particularly those in person-to-person contact industries. And so I think there probably is a debate to be had. What can we do to continue to help small businesses? Some will fail because of some would have failed whatever happened. Some will fail because of the resurgence. But to the extent more of them survive and are viable over the long term, but for the pandemic, I think we'll be able to manage more effectively the unemployment rate and limit to some extent the number of people who lose their jobs. But that's one opportunity to look at whether we can do for small, mid-sized businesses. But otherwise, the Fed has, on the one hand, plenty of firepower, and it has a role to play. But the key, I don't want to mislead anyone, the key to how the economy does from here is going to be directly related more than anything else to how well we follow the healthcare protocols and manage the transmission of this virus. And I believe it is in our power to do that.
Just a word on the negative interest rates. I know this always comes up in these conversations. Are you ruling that out on technical reasons? Are you ruling it out because you just don't think the situation will get that bad? Or is it a basic point of philosophy that you'd be basically ruining the value of money once you start bringing in negative interest rates?
So I'm worried about a number of things. One is we have a very substantial financial system in this country, which includes a very substantial money market industry. Many companies are reliant on the commercial paper market that relies on a healthy money market industry. If you had negative rates, I worry about the damage it would do to money market industry ability to use the commercial paper market and to financial intermediaries generally. And then I say, is it worth the damage for the benefits? And when I look around the world at the effectiveness of negative rates, I think the jury for me is out as to whether it's had a positive effect. And so I think there are a number of other things that need to be done on the fiscal side, on investing in our workforce growth and our productivity and infrastructure that I think would be better priorities. And I think negative rates is something at the moment list I would not want to seriously or actively consider.
Well, I think the jury's come in Sweden. They've come in because it hasn't had the right effect. Is your view here, fairly strong view, is that shared, do you think, by the FOMC colleagues? In other words, can we basically rule this out and we don't have to ask this question ever again because it's not going to happen?
I don't want to speak for my colleagues, but you've heard the public statements I think others have made. I think this is not a viable option for us to be actively considering at this point.
You mentioned the budget deficit and how debt could go up. Clearly, if we have another serious downturn and we don't have the recovery we hope for, In terms of the Fed actually buying government bonds, if the budget deficit were to go up still higher, presumably the Fed would simply go in and buy pro rata so that there is not a problem in terms of the issuance calendar. Can we think of it like that, that you're more or less matching the increase in federal government borrowing through your open market policies?
So we certainly have been active in buying treasuries and mortgage-backed securities, but particularly treasury issuance. And the Fed is got an increasing percentage, percentage of the total new issuance is being bought by the Fed. The only issue is the more of that we do and the more of that we need to do in the years ahead, it's not free. It has an effect on the dollar. It may ultimately have some effect on the dollar's role as a world's reserve currency. We're already seeing dollar weakness play out, metals and other things rallying because of it and undermine some confidence. So we can do the things you just described. I think on the margin, we don't want, I personally don't want to do any more of it than we have to because it does have side effects. And I'm conscious of those side effects.
Well, let's go into this question of the international role of the dollar. I've also got a few questions about the US system. Let me also remind people that they can send in questions to OMFIF, and we can also use the chat function on this webinar if you've got some questions from the audience, which I can then start reading out in about 15 or 20 minutes. International role of the dollar. Now, I know it's the Treasury Secretary who speaks about the dollar on the whole, but you've made a fairly strong statement here, Mr. Kaplan, just to say that this weakness that we saw just for a month could have a deleterious effect on the dollar's longer term role. You mentioned also a metal. Well, gold has now shot through the $2,000 barrier. Are you seriously worried about the dollar's systemic world role?
Not in the near term, I'm not, but I think I was saying publicly before this crisis, that I was concerned that the path of U.S. government debt to GDP was likely unsustainable. With debt held by the public now in the mid to high 70s, and the present value of unfunded entitlements, now in excess of $50 trillion, very large amounts, that we were going to have to do some things to moderate our debt growth. And so all I'm saying is now, because of the pandemic, those issues have gotten even more pronounced, and they have implications. It has implications for tax policy, productivity, size of government debt to GDP in the years ahead, and eventually, yes, we're able to manage all this because we presume that the dollar will always be the world's reserve currency and we'll be able to finance this. And that may be true. I'm hopeful about that, but I think it's dangerous to rely so heavily on that presumption that will continue indefinitely. And I think this gets back to the virus. These dollars we're spending to offset some of our challenges in managing the virus, the dollars we're spending because of that it's money that just adds to the national debt and has longer term implications. I just want to, in my role, point it out and say we should be conscious of that, and I'm very conscious of it.
Is the reason why the gold price has gone up mainly because, in fact, there isn't at the moment a viable alternative to the dollar in terms of paper currencies? The different contenders, the euro is clearly the number two. We have the yen, the renminbi, the pound sterling. None of them look like champions, frankly, I would say. You might like to comment on that, but is that not the reason why the money has gone into gold?
I'm gonna avoid in the seat I sit in now commenting on why any asset class is doing what it's doing, other than to say I am concerned about the growth in U.S. government debt and the implications that this has on the United States, and I just want to be conscious of it.
I've got a question from the audience, which I'll bring in straight away here. I'll just read this question out. Why the reluctance to give stronger state contingent forward guidance on interest rates now? what are you waiting to see before you would be willing to take this step? I presume the question means putting interest rates up as well as bringing them down. I don't know what the questioner has got in mind, but would you like to answer that question?
Yeah, my own view is we've given pretty strong, in my mind, we've given pretty strong state contingent guidance, and we did it in the form of our forecast for the Fed funds rate for the next couple of years, and we'll be submitting that again in the September. We'll be updating that in the September FOMC meeting. So I think it's pretty well embedded out there that rates are going to stay low for an extended period of time until we make more progress on our dual mandate objectives of full employment and price stability. There will be an opportunity, I think, in the future to maybe give more precise forward guidance and add to that forward guidance. But I personally would like to see more clarity in terms of the path of the virus, the path of the economy before we did that. And I think we've given pretty substantial forward guidance, state contingent forward guidance already.
Just in terms of what you've been saying now about the role of the dollar and the budget deficit and so on, it's very, very clear that the Americans do have the strongest and the deepest financial markets in the world, and that has done the Americans proud throughout successive crises. Do you think that an over-reliance on government borrowing, and also were that to be somehow bracketed with negative interest rates, could do irreparable harm to the depth and the reliability and the technical capability of American financial markets, on which this universally accepted supremacy of the dollar does seem to depend?
Listen, I'm optimistic that the U.S. will ultimately do what needs to be done to manage this virus, that we'll be able to, while we'll have to do more on fiscal policy and obviously monetary policy, we'll do a better job on the virus and hopefully limit on the margin additional amounts we need to do. And then I'm confident and hopeful that we'll begin to recover. And on the government debt side, I would probably differentiate in the years ahead between government debt that it goes to investments, which include infrastructure, things like Wi-Fi, investing in our education system, improving early childhood literacy, all the things that improve, that are investments that improve future productivity. I think those things are very, very important. I'm a little more sensitive about limits to our ability to keep spending government debt to fund consumption and the impact that that has. But I'm confident in the years ahead that as a country we'll get that right. And because of that, I'm hopeful, and I'll try to do my part in this job. I'm hopeful we will continue to have deep and liquid capital markets, and will be a place that people globally want to invest.
I think Winston Churchill once said the Americans will always do the right thing in the end after having explored every single other option. So in a sense, the handling of the crisis has shown that. But what you've said just now actually brings me to the subject of the elections and what you might call the American system. Many people, not just critics of America, but many right-thinking people have said that this crisis has exposed some deep-seated structural shortcomings in the world's largest and most vibrant economy, i.e. in the United States. Look at inequality, look at lack of medical attention in some areas, look at racism, for example. All this will be a potent cocktail for the election. Now, you are a former professor of management practice. You've written books about all this. I know you're not running for the election, but how would you change the system?
Fortunately for everyone. I'm not going to talk anything political and obviously anything about the election. I would say before this pandemic, I was talking frequently about the need to find ways to grow our workforce, bring underrepresented groups into the workforce, and in addition to invest in education and other our healthcare system and in infrastructure that would improve the health and productivity and educational attainment levels of our citizens. And I still think as we get beyond this crisis, I think there's a huge opportunity for us to do that, and that we still are going to have to get back to the fact that GDP growth is made up of growth in the workforce and growth in productivity. Workforce growth in the United States has been slowing because of aging demographics, and the productivity, while it's been very strong in certain industries, overall it's been sluggish. The growth of it has been, and I think a big part of that reason is we need to improve educational attainment, early childhood literacy, and improve skills training. And so I think that in the future, there's an opportunity to create a more inclusive economy, and the fact is we'll grow faster if we do. We'll have a better economy, and we'll all be wealthier if we have a more inclusive economy. But that's going to take investments along the whole education ecosystem, the healthcare ecosystem, and investing in infrastructure that makes us more productive.
Is it the role of the Fed to start talking about that? I know you have a dual mandate, which does give you more leeway than other central banks, but you're starting to talk about systemic issues, which one might think is not part of your domain.
It has been part of my role in the way I've approached this job at the Dallas Fed to talk more broadly about some of these issues. Particularly, I've been very vocal on early childhood literacy and education, one within the state of Texas, because I think it will help our economy, and to connect those investments and inclusion to faster economic growth. So my job is to make sure to make good monetary policy decisions, but I also think part of my job is with my team here to analyze the economy in this district and nationwide, and to call out things we're seeing. And I think we have a valuable role to play. So I'll give you an example. We just did education. The governor and the legislature passed education reform in the state of Texas now over the last 2 years. And I think the research we did on early childhood literacy and improving educational attainment, particularly for Blacks and Hispanics, was one of many factors that went into the thinking. But I think we can help policymakers by sharing our research and to make decisions that will help us grow faster and create a more inclusive economy. And I think, for example, people in Texas concluded if we had a more inclusive economy, we'll grow faster, we'll have a better future. And so I do think that's part of my role in this job.
Is this part of a role maybe for central banks worldwide? Because clearly they are getting dragged into political issues, whether they like it or not, simply through quantitative easing, which does take central banks into a fiscal policy.
Let me say, I don't see it as a political. I don't see it as a political issue if it's an economic issue and affects economic growth, and I can talk about it in an apolitical way to the extent humanly possible. I think that's part of my job, but it's to stay away from the political aspects of it.
It's maybe talking about things with a small p politics rather than a big P politics concerning elections, but it's a kind of socio-political issue, isn't it? What I see is that central banks all over the world are getting caught up in, shall we say, societal issues. Let's not use the word political. And this is something which happens. Now, you go down that path at your peril, one has to say, because people might accuse you of meddling in politics. You've just said you don't want to do that when it comes to elections, because people will say, well, you're just a bunch of unelected technocrats. You're there to worry about money. And there is a dividing line, isn't there? And it's important not to go across that demarcation line.
Yeah, listen, I've said this many times. Part of my job, I believe, as a central banker, is to point out the limits of monetary policy. And that we've had central banks since the Great Recession have played a substantial role in economic policy. And I think part of my job is to point out there are limits to monetary policy and to show some humility.
Good. Well, I've got quite a number of questions coming in, so let's just have one or two here. I've got a question, for instance, from Colin Robertson, who's a well-known commentator and guru on monetary issues in the United Kingdom. And he says, can you please comment on the outlook for the supply side of the US economy? Has it been damaged to any meaningful extent, including by changed corporate behavior?
So you cut out in the early part. you're going to have to repeat the question. I apologize.
Yes, so it's about the supply side of the US economy. Has it been meaningfully damaged, including by, not just by the crisis, but by what the questioner calls changed corporate behavior?
Yeah, so what we've just seen, to your questioner's point, is partly a supply shock and a demand shock. And on the supply side, we've got limits and constraints on a number of things that we produce, and I think this crisis has made us aware of that, and so I think there will be some changes in how I think we look at our economy, what things need to be done within the United States, which types of things can be done globally, and in those cases where we've got shortages and supply constraints, I think there are already conversations about what we can do as a result. A lot of what we tend to talk about in this crisis is the demand shock element of this, but as your questioner asked, there is also supply element.
I have a question also from Mark Sobel, a former Treasury official who's now our American chairman. And he asks very simply, and this ties in with what we were talking about before about government bond purchases, how do you feel about yield curve control?
I am right now a skeptic on yield curve control. And there, I'm going to keep an open mind about it. But right now, Treasury yields, as we know, are low, historically low. And I'm sensitive along the lines we were talking about earlier, actions we might take that further muffle the pricing signals of markets or distort the pricing signals of markets. I think there is a cost to those actions. It can create other fragilities in the financial system. And so obviously asset purchases, large scale asset purchases also can have some of that effect, but I think yield curve control might even do it to a greater extent. And so I don't yet see a need to actively consider yield curve control, but I've learned in this crisis to keep an open mind, and I will continue to do that. But I would prefer not to go down that path.
Another questioner asks about something fairly fundamental, your monetary policy strategy review of your tools, your communications, your whole stance. How are you getting along with that in the middle of the crisis?
As has been publicly said, it is moving along. We'll have more to say about it I think in the next number of weeks. And so I don't want to comment too much on our private deliberations there. I have said publicly up to now, I would be comfortable with the likelihood that we would let inflation run above target moderately, keyword being moderately above target for some period of time in those situations where we've been running persistently below. That is a inclination for me, not a commitment. I don't want to be making forward commitments to what
and it's not a forecast either. You're not forecasting that that is going to go above 2%.
It's not a forecast and it's not a commitment, but I think it states a tendency or a likelihood. Also, I do think, as I've said publicly before, explicit consideration of the financial system and financial stability in our actions as we balance our decisions, I think, is appropriate also. But we'll have more to say, and I'll keep comments on that to myself until we make some more public statements.
Is there a date now for when this is supposed to be concluded, or is it like a long running?
We've not set a date, and I'll leave it actually to this is one where I'll leave to Jay Powell, to our chairman, to publicly comment on this.
Another question on a forward-looking issue about digital currency. Other central banks in other jurisdictions are moving much faster on this issue than the Fed and the United States authorities. It comes with all sorts of complex tech, privacy, and other issues. It could revolutionize how retail money works, and it could also bring geopolitical benefits for those who go first. So it plays into this issue about the dollar as a reserve currency. Do you think America should go further and faster and more radically on digital currency?
I think we should be studying it and actively looking at it. And that's probably the extent of my comments on that today. I think it would be wise for us to be actively studying it and looking at it.
This comes in to the issue about China, which I wanted to ask you anyway. The Chinese have been pretty rapidly out of the blocks in this issue of digital currency. They've filed all sorts of patents and so on. I don't know whether they have got a plan for world domination by the renminbi. I suspect not, but they do want to boost the renminbi as a world currency, as everybody knows. Do you think that's likely to be successful in the coming 5 to 10 years?
I don't know, but I would say that I've learned over the years that the future is unlikely to look like the past. And so I think we need to be prepared and ready to be adaptable, because I think because of technology, digital currencies, other trends that are going on, the world is going to evolve and is going to look differently, and we need to be attuned to that.
I've got a few more questions on other subjects, but let me just stay on China for the moment. This is a big issue also in the American elections taking place now in November. It's going to be a big issue afterwards as well, whoever is in the White House. Now, you are at the center of a very big industrial community there in Texas. You're not just talking to money men, you're talking about industrialists as well. How do the colleagues, the people you see on the ground doing day-to-day work with China, how do they see this dispute with the White House playing out, and how do they see the future, irrespective of who is the incumbent next year?
So it's been a very relevant issue here because we're the largest exporting state in the country. Texas is, and so we tend to look in an integrated way, not just at the trade relationship with China, but also a big topic of conversation here is our trade relationship with Mexico. And so I have commented consistently that it's very critical that we get these, that we continue to have these integrated supply chains and logistical relationships with Mexico. And I'm hearing that from my contacts broadly. Those relationships have allowed U.S. companies to domicile here, add jobs here. And the concern of many of my contacts here is if we didn't have those relationships with Mexico, we would actually lose share to China and maybe lose jobs to China. That helping North America and thinking of North America as an integrated sphere has helped us attract jobs and get share. As it relates to China, the other thing our contacts are sensitive to is obviously for many companies here, they look at China as a big market. Many of them have facilities there, do business there, and they also have logistics and supply chain arrangements with China. And they're looking at alternative arrangements and have been doing that now for the last couple of years. And so I think that will continue. And I think people here are very conscious that tensions with China and the global competition with China is going to continue for the rest of our lives. These issues are not going to get resolved quickly. On the other hand, I think there are many opportunities to integrate with China and get the benefits of that integration, and which would in fact help US become more competitive and companies here be more competitive. So it's a complicated subject, but yes, it's one that folks here are thinking about very seriously, and it's causing them to think globally about their sourcing and supply arrangements and look at alternatives for how to position themselves.
So not to become too reliant on China, that seems to be a mantra that spreads through the community. You had these 23 years at Goldman Sachs, and obviously Goldman had a very strong relationship with China, still does in many ways. Yeah. I remember President Trump saying in one of his early interviews that President Xi himself allegedly had told him, Mr. Trump, that Xi thought that the Americans had been too soft on China and almost given the Chinese too much leeway over things like the World Trade Organization and so on. Do you think that's true, that under successive administrations, we were so keen to bring the Chinese on board that we, the West in general, cut them too much slack? And now this is the time to to take some of that slack back again?
And you may know I lived in Asia for 5 years and ran our business there for Goldman Sachs in investment banking. So I think there's an acknowledgement. Put it differently, there's an acknowledgement that China is, and it's been true for the last 30 years. China was going to be an increasing percentage of global growth. That if you're going to be a global company, there's really, you don't have an option but to be in China. And certainly that was true at the firm I worked at. But that creates a whole range of challenges, and you want a level playing field and worry about intellectual property rights and technology transfer. But I think there's an acknowledgement that we're in a competition with China, and they're becoming every year an increasingly powerful force in the world. And this competition is going to go on for the rest of our lives. But it's not binary. There are opportunities to be integrated with them, and there are challenges where we are on other sides of the table. And I think most companies I work with think about that in not a binary way, but in a multifaceted way, and are just realistic about the future and the relationship.
Yeah, well, thank you for that. Quite a slew of questions coming in the remaining 20 minutes, so I'm going to just apply them with a machine gun rapidity coming at you from different directions. One is about NPLs. The banks have gone into this crisis with better capital ratios than 12 years ago, but nonetheless, are you worried about NPL impairments, not just for banks in your jurisdiction, but more generally, and that this could actually create some worries about financial stability?
Well, we're watching it very closely, but I would say banks that I look at, big and small, the whole ecosystem, they have heavily reserved in this last quarter for potential loan losses. And I think still, when we've just finished our stress test with the big banks, I believe that while it's not perfect, I think the banks are in relatively good shape. And the thing we don't know is how much, if we can manage the virus and we can grow our way out of this, that's one scenario. If there's a severe deterioration, if there's a second wave, if we don't effectively follow the protocols and we don't manage the virus well, will that create new potential loan losses and other issues? It could. But I think based on our base case, we think certainly the banks are in much better shape than they were last time. And I think the tough capital requirements and stress testing, I think, has served us well here. We just have to monitor very carefully how the economy unfolds, and that's uncertain.
And just a very quick add-on to that, in your jurisdiction, given the importance of the energy economy, has the latest improvement in the oil price been helpful from the point of view of NPLs, would you say? Just a very quick answer to that question, please.
Probably not as much as you'd think. The reality is you're still seeing substantial shut-ins. We think U.S. production will decline as much as 20% year over year. That's a huge decline. CapEx is down dramatically. Many banks are reducing their allocation to the energy sector. It's harder to get funds if you're an energy company. And we're going to see many more bankruptcies, restructurings, and failures in that business. This is a very tough year here.
A systemic question, building on what we said before regarding the dual mandate. Is there a case in your mandate to extend this to the Fed addressing racism and inequality? Question mark.
Well, I'll talk about the way I currently approach this job, and I'll speak for myself, but many of my colleagues across the system do the same thing. I've been looking for the last number of years in every measure I look at of unemployment. I look at unemployment by race, by Blacks, Hispanics, women, and then by educational attainment, high school and less. We look at all those aspects, and particularly I'm looking for underrepresented groups. And so part of my thinking in 2019 and even 18 was why I thought we could run hotter is when inflation was muted, but I also believed that there was enough slack capacity. If you looked at the unemployment rates of some of these underrepresented groups, there was room for improvement, and we could run hotter and get them back into the workforce, and which is what we did. So it's been a factor in our thinking now for a number of years.
It's implicit. Should it be explicit? That's the question.
I wouldn't have a problem with that if it was. It's certainly explicit in our own deliberations here, and I've seen it, observed it across the system.
Well, thank you. That's one for the review. Another questioner asks whether the lower dollar that we saw, certainly in July, is this actually a good thing? Is this favorable for your inflation target, financial stability, and also for full employment? Has this been discussed by the FOMC as a tool to help you get into the right inflation direction?
Yeah, I don't look at it as a tool, no, for that. And I'll just give you my own personal view. We don't target at the Fed the currency specifically. Obviously, we've always conscious of the implications. If it's weaker, it helps exports, makes U.S. goods more competitive. I'm interested in financial stability, though, also, and the proper functioning of the markets. And in that regard, you know, I also look at the stability of our markets in general. And so, you know, at least I'm conscious of what's going on with the dollar as a factor in that.
It has been perhaps helpful that the incumbent in the White House has been making less pointed remarks about the Fed in the last 6 months or so, including on the dollar. Do you see that as a positive factor?
I wouldn't comment on it.
And then I also have a question going back to the economic mainstream. You see a lot of industrialists. You worry a lot, as you said earlier, about what might happen if we don't get the economic results that we're hoping for. What particular economic spots do you see in the economy which could pose a problem because they're going to be growing at a less fast pace than the other more buoyant aspects?
Well, let's get right into it. The segments of the economy that we're seeing that are lagging are those businesses, tend to be service sector businesses that rely on person-to-person contact. Restaurants, arts, entertainment, hotels, airlines, any industry that relies on person-to-person contact is very challenged right now because consumers are reticent to be fully engaged in those sectors. And this is where I bring out the medical part again. Epidemiologists, and I spend more time talking to epidemiologists than I'm on the board of Harvard Medical School, so you'd think I'd talk over the year. I've talked to more doctors in the last 3 months than I have in my entire life.
You look pretty healthy as a result, I can tell you that.
Well, maybe we'll see about that. But the epidemiologists have encouraged me, have told me the story about using masks to guard against tuberculosis and other communicable disease over their careers. And they feel very strongly that if we all wore masks, we would be able to substantially mute the transmission of disease, and we could get back on airplanes and in stores and in maybe not big crowds and probably maybe not bars, but be much more involved in person-to-person contact industries. But I think, unfortunately, as the virus resurges, those industries are lagging. And that's what we're seeing as the most challenging part of the economy. But those sectors employ lots of people. They disproportionately employ high school and less educated people. They disproportionately employ Blacks and Hispanics. And so we're seeing this pandemic disproportionately affect those at-risk groups. And it's those sectors that are lagging that are a meaningful part of that.
I've got about four more questions in the remaining 10 minutes. Just before we get into this. Do you pay attention? Do you play a role yourself, Mr. Kaplan, in terms of going out to the bars and the night spots of Dallas wearing a mask? I'm sure. Are you doing your bit to promote the retail and hospitality industry?
Well, I'm out there. I'm part of a number of task forces in the state that's helping with that. But in addition, yeah, I walk around after I put one child to bed and I have a little break. I usually go take a walk, and I try to go out every night and look in restaurants. And I do go out to restaurants. I've stayed at hotels through the district, in Houston, for example, and try to talk to small business people every day, either in person or by phone, to try to understand what the challenges are they're dealing with.
And you don't always say, I'm the president of the Dallas Fed. You simply
I
go
never
in
say that. I just
there.
go in as a customer or a patron.
Great. A longer term question, thoughts on inflation in the next 3 to 5 years? There has been some talk about resurgence of inflation. And then linked to that, are you worried about moral hazard? You spoke earlier about the SMEs.
Yeah.
There's the issue about zombification. Could you deal with those two questions in a minute or so?
Yeah. So I think in the near term, inflation is going to be muted because we have so much overcapacity. I think as we hopefully in the rest of this year and in 2021 and 22 get rid of some of that overcapacity and have a lower unemployment rate, we'll have to see. I think you may see some surprises on the inflation front, but in the medium term, I think most of the forces are disinflationary. And I'm always conscious of the fact you've got technology-enabled disruption that's limiting pricing power. On the moral hazard part, I'd put it this way. In the middle of a crisis, there's a need for the Fed to take bold action. But I do think, and I've said this publicly, the programs, particularly the 13.3 programs, need to have an end date. They'll need to sunset. And we're going to have to say that regularly. The public markets and the markets generally need to understand that they will need to function without Fed involvement at a certain point. We will need to pull back at the appropriate time. Just we can't do it in the middle of the crisis, but we will eventually do that, and we should say that.
So the policy put will not last forever. That's quite clear. And it's also obvious that the word moral hazard is not just a German word. We had a panel the other day. We had the Banca d'Italia and the Bundesbank both lecturing us about moral hazard. So that does show, doesn't it? That does pass on through boundaries. Question on that issue, ECB. I know you don't really like talking about other central banks, but we're amongst friends here. How well do you think they're doing? Bear in mind, this is a very unusual central bank, a supranational organization, the EU, with one central bank. How many marks out of 10 would you give the ECB so far?
I will dodge that question. What I will comment on more is we study very carefully here at the Dallas Fed how each of the countries is doing in managing the virus, their adherence to protocols, why, if there's some that are doing better, why are they doing better? And I think there's a lot to learn, I've found, from studying those countries.
That's very diplomatic. If you haven't won a diploma already from Harvard for diplomacy, you'll get one now, I would say. Now, a lot of people are worried about sustainability. That really is writ very large in many, many tracts. Not just Al Gore, everybody seems to be on the ESG side these days, including central banks. Now, the Fed has not been part of this network for greening the financial system set up with the Banque de France very much in control of this. Its secretariat is in Paris. Do you think the Fed particularly should do more in terms of, quotes, greening, end quotes, the financial system?
Well, you're seeing a number of us. I've talked a lot about it. Mary Daly in San Francisco has talked about it. I've written a paper on it specifically. And you might be surprised, you might not be surprised, despite the strong contingent of energy companies in this district in Texas, many of them are actively working on issues like sequestration, how to limit their footprint, their global GHG footprint, how to review their suppliers. So this is a big issue. We're the largest wind producing state in the country, Texas is. And so I actually think that investment in energy and sustainability is a big opportunity, big commercial opportunity. And I think if we've learned anything from this pandemic, tail risks, when they happen, are extraordinarily costly. And so you don't want to, you want to do what you can to limit the probability of those tail risks from occurring. And sustainability is a classic example of that.
But quite specifically, when it comes to central banking tools, say in your open market operations, there's been some talk with the ECB, for example. Christine Lagarde has been mentioning this as well, whether the ECB should really favor green bonds. You know, once you agree what the taxonomy is, of course, for what green bonds actually are. Is that something the Fed could ever do? Because that really is getting involved in a market mechanism if you were to do that.
I'd have to think more about that, whether that's other than for me talking about it, whether we are actually favoring one industry over another or sector over another. I think at the moment, probably not part of our mandate, but obviously could become part of our mandate. But I don't think that's going to be, I don't know that I'd be in a position to, we'd be in a position to decide that.
And then just another question. I seem to have a whole slew of questions now about climate risk and so on. Something that Mark Carney kicked off about 5 years ago, but worried about climate risk as a source of systemic financial risk. This plays into the stress test that you've mentioned, but it also plays into the question of stranded assets. And you are a major center for assets which could be thought of as stranded in coming years. Is this something that either keeps you awake at night or that you discuss very much with the energy conglomerates in your area, or conceivably both?
So you can't run the Dallas Fed in this district without thinking about these issues every day. And why? We've had substantial hurricanes, flooding, drought, a number of the byproducts of climate change. Those tail risks are actually happening here, and they've been extremely expensive. And so we're actively talking about that. And yes, it will mean that certain assets have to be repurposed or are no longer viable. That's part of capitalism, but it's also part of this. And so yeah, we're spending a lot of time talking about that because we're living with tail risks, because some of them are actually occurring here. And I know they're occurring in other parts of the country, whether it's fires in California or droughts in the Midwest, but we're experiencing them. So it's definitely part of our consciousness to talk about them and think about them.
And this presumably is system-wide. It doesn't simply go for the Dallas Fed, but you think also
that's right.
The Feds in other jurisdictions are doing the same thing?
In varying degrees, depends on the composition of their district, but yes. I think these tail risks are more conscious. They're with us. They have an economic effect. And I think this is an increasing, and the companies more are at the forefront in thinking through themselves what to do about it. So if you want to understand what's going on in the economy, this is part of the trends that are going on now.
Final question from Mr. Sobel, as always, the one that might ultimately give you nightmares. Do you worry that if the debt keeps going up, the Fed may ultimately face fiscal dominance and its independence could be questioned?
I think we have to be cognizant that as if the path of government debt is unsustainable, and the Fed has to play a role in addressing that, it's a risk we ought to be cognizant of. Let me put it that way. And so I think as we do what we do now, I think it's always good while we're in the middle of a crisis to think through the implications longer term of what we're doing and be conscious of it and be willing to debate and discuss it.
But let's say, to put a number on it, let's say you've got a range between 0 to 10 in terms of worries about fiscal dominance and your independence being constrained. Where are we on that path, with 10 being a time when you are going to lose your independence? Where are we on that path between 0 and 10?
I'm probably not going to give you a precise answer. I would put it this way. Given the role we're playing here, I think we'd be wise to be cognizant of these issues and cognizant now, even though we're in the middle of a crisis.
Okay, well, I hope the word cognizant is something that also plays well to people who may either be in the White House next year or are thinking of being in the White House in years to come, because it really is a big issue for us all. I'd like to thank you very much, Rob Kaplan, for taking the time for this. We've gone through a whole staccato series of questions, from everything from racism and inequality to the future of yield curve control, China, and the domestic political system. We've touched upon the elections without getting political, but we are certainly societal. And I think what you've told us is that people at the Fed these days have to worry about society as well as about money. And I've got no idea how long you're going to remain at the Fed in Dallas. Some of your colleagues have been there for longer than 10 years, Charlie Evans and Jim Bullard. So maybe you're halfway through, or maybe I don't know what your plans are, but I do hope that you carry on worrying about and paying attention to and making a difference to these societal issues as well as the money issues. So thank you very much indeed for being with us.
David.
thank you everybody who's been asking this great array of questions, and thank you for your answers. The questions and the answers matched each other, I would say. Many thanks indeed.
Thank you.
Look forward to the next time. I hope everybody's well and healthy, and hope Dallas does well. Goodbye.
Thank you.